All right, everyone. Welcome, welcome. We're here with our boy Amin from EarningsWatcher. Amin, thanks for
Hey,
joining us, man. How are you doing?
I'm doing great. Thanks for having me, guys. Glad to be here.
Yeah, good, good. Very well, very well. And yeah, I'll let you jump into it. Explain to us your background, what you're doing, and yeah, go ahead.
So nice to meet everyone. So my name is Amin. I'm 36 years old. Basically, my background is in data science, analytics, and with a layer of business interaction development on top. Basically, my last job was spent 3 years at Palantir from 2017 to 2020. Um, were really so that was actually sort of the running ground for data and that business layer I was speaking about. Then I started this so EarningsWatcher, this basically platform around these perhaps not so famous, not so known earning strategies that really revolve around the concept of what happens to implied volatility around these earnings events. This is actually a playground where that data, the data science, analytics, probability, statistics, etc., really plays a lot, and so it was really a natural fit for me. Started this really organically on Reddit with a simple newsletter around 3 or 4 years ago, and then slowly basically grew with a full platform with a lot of tools to really, I like to say, 360-degree research these earning strategies. I'm sure a lot of perhaps people are familiar with these strategies. Really, this is a place where you can do and research and prepare all of this in one place. And for people not so familiar, actually make it intuitive, accessible, and really, how do you say, make this edge accessible to retail. A great edge based on this data analytics, etc. So very happy to be here to give you a tour and a live use case of how we do things at EarningsWatcher. So yeah, very happy to be here.
Okay, awesome. Amin, a question from myself. As far as like market background, while you were at Palantir, I assumed you've always had interest in markets and trading yourself.
That's actually a great question. So basically, the from my school background, the school I went to, the university here in France that I went to, is very famous for its finance, basically preparation. So finance at the end of the day is really math. So I sort of took the route of math as in applied statistics, what would become later on machine learning, artificial intelligence, etc. So in that I worked at startups, Palantir, etc., where really that was my focus. These again based on applied mathematics for statistics, probabilities, etc. And then after Palantir, the reason basically I found myself back into the markets, being an options holder of Palantir myself. I sort of like it was a full circle story where I sort of dived back into what I had studied back in the day. Now, obviously, we have studied options, finance, etc., from more of an institutional perspective. But what I like of now actually applying those data skills, but now on a retail thing, and actually on this finance field that sort of has always been there in my background. So now after the experiences in startups, Palantir, with the business, etc., I've sort of ended up coming back to it. So that's the full story. If that makes sense.
Cool. Yeah, yeah, yeah. Very well. Yeah, very cool. Coming full circle. Um,
Exactly.
and I guess one more question for me, and then I'll let you. I've given you access to share your screen. I'm sure you have some stuff
Cool.
you
Yeah.
want to share with us. Now, for earnings watchers, are most of these strategies options related, or can it also be used for underlying stock trading?
So I would say the big chunk of the strategies is best played with options. Why? It's because of really this notion of implied volatility that really plays a lot in option trading, and it's really so very very linked to the dynamics around happens around earnings. Now, with that being said, I actually day after day I keep getting also amazed by what I see our members do, and so also many of them are not necessarily options traders, and so they would use some of this data for other strategies or playing it directly on the stock, as you mentioned. But eventually, even people who start like that will get a foot in the options world and end up picking it up, because as you know, picking up actually the option knowledge, the fundamentals of options is not that hard. And the idea is really what's good about these earning strategies is that, what I like to say, they're a good application playground actually. After you're familiar with the basics of options, really earnings are these events where a lot of things play together. So whether it's the implied volatility, the stock move, the IV dynamic, etc. And so it's really a great way to even step up after learning the fundamentals. I know that a lot of people, when they get into options, perhaps struggle with what type of edge to get. So I know a lot of you guys do technical analysis, which is a great way to approach things. This is a different type of sort of edge or approach, a bit perhaps more macro, but yeah, I would say 80-90% of it is best played with options. But the good news is that this is quite accessible, and it's becoming more and more intuitive for a lot of people.
Yes, very well, very well. Cool. So it's good looking software here. Go ahead. You want to give us a rundown here?
Okay, great. So I'm sharing my screen. I hope you guys can see it. Okay, so I think this is best shown with a concrete example. But before that, so let me actually maybe give 5-10 minutes, really a quick breakdown of what are these strategies, just so people are up to speed and understand what we're talking about. So here on the platform, I'm sharing this tutorial screen that really tries to break down how everything works in general about these strategies, but also on the platform. So I'll use that as just sort of a background to discuss things. Now, really, guys, the idea, again, as I said, is these IV dynamics that happen around earnings. So let's break it down in a simple way. Basically, as earnings events approach, obviously, the market is sort of aware that each stock, depending on the stock and what it is, would actually move on earnings, right? We're all familiar with stocks, making big or small moves, but actually there is actions happening there. Now, of course, this is priced in the market in a way that, of course, you would not expect to find the same prices of options a bit before earnings compared to a random day, because of that expectations of move. How does that show up in real life? It's through this implied volatility. So basically, leading up to earnings, we see a rise in implied volatility. This directly makes the option prices more inflated, more expensive. What does this mean? It means that we end up with a break even of any options. It's a call or a put or a straddle or whatever it is, that will be higher for earnings than outside on a random day. So this is the first dynamic, this IV inflation. So to sort of, again, the market pricing in certain expectations of what will happen. And then I'm sure a lot of people have heard the term, what happened just after the release, this what we call IV crush, where this implied volatility really drops. Makes sense, because this whole frenzy and excitement and expectation is sort of now gone with the new information of earnings released. And so we see this impact where basically now options come back to the regular prices. Okay, so as you can see, this dynamic can open up basically doors for opportunities and for research. You can see it directly by the simple fact that what's the playground here is that the markets, and so when we say the markets, it's really markets participants, offer and demand. This is what's behind the dynamic of this IV rising up. But this is the important thing, is that they are expecting a certain amount of move. This is perhaps a term that people have heard before, what we call implied move. So this is the expectation of the stock move that will happen on earnings, priced in by the market. Where does the edge come from? Basically, guys, you can see it here directly, is the fact that obviously there's this forward projection, this forward prediction of what the market expects, but then there's also basically what happened in the past, the realized volatility, how the stock actually moves on earnings. And you see how the game here basically is how efficient is the market in pricing in these moves, right? This is really this setup about how we approach these things. You can think of it of these mispricing opportunities. And so these strategies are, as you can see, rely on macro approach, really about actually isolating what happens on earnings and really studying the name and the outlook of each name depending on how it behaves on earnings. So to sum it up quickly, there are really three groups of earnings strategies. So as you can see here, trying to show in this quick graph, the first group of strategies is what we call IV rush. This is what we discussed, the inflation of IV. Now, obviously here, there is room to play this inflation in IV, because as you can tell, it's a battle between the inflation of IV versus the theta decay, basically. Because here, as you can see on the graph, we would be entering and exiting before the release. We're not really going through. We're not going through that IV crush and that expected move, etc. We're really trying to play how if the inflation, the rush in IV will outpace theta decay. And so this is sort of a more conservative approach to earnings. You can ask, well, how can we play this? You see how already data lays sort of the fundamentals of the basis to give us this edge, because the idea of finding the best candidates of IV rush is actually developing. So this is what our platform does for the specific tool of it. Actually developing this, again, this is where we come back to math and data, etc. A mathematical model that tries to isolate this IV component and really focus on the names where the threshold in IV is the highest. This is the first group of strategies that happens before earnings. This is somewhat perhaps a bit of a niche or not so popular. That's getting more and more popular actually as a strategy. The second group, which is the most famous that I'm sure people have heard about, is so going through the release. This is what we call long and short volatility. So as you can see on the graph here, the idea is we're entering before, we're exiting after, and so we're going through that infamous IV crush that as we said, really, basically, this drop in IV should bring down option prices because, as we said, this offer and demand, this frenzy in inflation has disappeared after earnings. Well, the idea is that basically here we will take positions to be either with the market or against the market, either siding, basically saying that, oh, we think that what's priced in this move, this implied move that we discussed is actually well priced in, that looking at how the stock behaved on earnings, on the realized volatility, on all the setup around it, we take position to sell options. This is really the approach here. And so profit from IV crush, we would enter basically before by selling, and here the structures, vary, short straddles, butterflies, condors, things like that. And then exiting the next day, the idea is that we would be able to buy back the position with a cheaper price because of the IV crush effect that would win, basically, in the stock not having a realized volatility that went outside of what was priced in. Obviously, as you can see, the symmetrical is the long volatility, where now we deem that the name perhaps is more volatile than what the market is pricing in. There's room for a bigger move. And so here the idea is we bet against it. So we call it long volatility because we believe that the stock volatility will beat the IV crush, basically, that happens on earnings. And now, just as a quick reminder, some people might believe that playing these strategies long and short actually always needs to come up with a big potential loss. People think of, whether you're buying just a directional position, calls, puts, or straddles with delta neutral, as we should do for these strategies. But you believe that if we're wrong, we'll lose 60, 70, 80% of the position. The good thing actually about earnings is that we can actually customize how we play any of these strategies, especially the long and short volatility. So we can always calibrate for positions with a big or low risk reward as the person would see fit. This is again one of the advantages of earnings, the ability to really choose what you play and customize how risky you are or not on each name. And so the idea again is, you see how this data layer and foundation helps us basically pick the names of this right name, this volatility seems mispriced, undervalued, or overvalued, and so we will buy or sell options. And just for context, these actually strategies, we did not obviously come up with them as smart as the team is and everybody is. This is not something we invented. This has existed in literature for decades, actually, when you think about it. And if you look at the research papers, the different books around it, the approach has always been to really use this angle of studying the past data, the realized volatility, basically, and the effect of IV crush, the risk reward, all of these aspects together, and apply these somewhat simple to complex mathematical models to really, you see the game, guys, it really comes up as each earnings move is like picking from a statistical distribution, basically. This is really where the edge comes from. And so if we have good enough assumptions about how the distribution of really these moves we were talking about, we can position ourselves really to put ourselves in the most favorable position based on what the data said. And so basically what we did is really make these strategies, as I said, accessible, researchable, and really intuitive to people with everything in one place, and really making these models even more powerful. I'll wrap it up on this intro with the final group of strategies that I'm sure here is very intuitive and makes sense to everyone, is what we call runners, basically what happens after release. This is really studying or playing the momentum, the drift that happens after the earnings are released. And so here, these are nominal market conditions. There's no IV crush. There's no any of the IV dynamics that happens. And again, why do we like it? Because we can actually rely on data, and the same approach that we use for other strategies, actually look at which names see higher drift or bigger momentum depending on which move, and position ourselves. So this is just a quick intro recap of what's playable basically for earnings. So obviously today we won't have time to do everything. The idea is that on the platform you can have all the fun you want, basically researching all of them. For today, I basically looked for a good use case that I think will make a lot of sense to your audience of Walmart earnings happening later on today after close. Does this make any sense? Do you have perhaps any questions about this, just the intro part, before we dive into the concrete use case on Walmart I discussed?
Yeah, no, very, very clear. Very, very cool stuff so far. Guys, you got any questions? You can put it. We're in the options and earnings channel. So any questions you guys can put in there, I'll relay it over to Amin. Amin, if you want to keep on going, showing us some other stuff, go ahead. And then as the questions come in, I'll relay them over.
Great. So yeah, feel free. I'll actually now start basically a concrete use case so people see how this comes to life. Okay, as we said, the platform really is tries to be this 360 place where you can do all of this research. So as you can see in the left menu, we have many things to do. The first things as we start in the platform is really, let's start to, and this is what we say, that this is a repeatable edge. This is a good thing about earnings, is that even though people might think earnings happen only during the week of earnings season, where Apple, Amazon, etc. release, actually those are just the sort of most attention-grabbing earnings. But earnings happen every week, actually, whether it's famous names or not so famous names. And this is what we like about it, is the repeatability of it. There's perhaps maybe 1 or 2 weeks in the year where really there is no earnings to play. Otherwise, really, this is the good aspect of it. And so the idea is that every day, every week, we could use a lot of these tools under the Discover section to start looking for opportunities for these strategies that we looked at. Now, obviously, you can tell the best way to find these candidates is by looking at this data that we're discussing. So let's actually start by a very straightforward tool called the Data Picks. What is the Data Picks? As the name says, it's really basically just a tool that surfaces the names that basically you should put on your radar for each strategy that we discuss. So as you can see, IV Rush, long, short, volatility, and momentum. How does it work? It really basically scans through all the upcoming earnings, and so for the current week and that we're looking at, and then looks for these basically candidates based on some data factors that will make them appealing for long, short volatility, IV Rush, momentum. For today, I think it's a good example that will make sense to your audience is something on long volatility, as I said, on Walmart. So what do we see here? as we open the data picks, is Walmart is showing up as a good long volatility candidate for these strategies that we're discussing. Why is that? So we'll dive into it in more details, but let's look at how the data picks is showing things up. It's showing basically the fact that a very interesting number here that we'll start with is the beat rate, that basically looking at Olive's past earnings, we see that 86% of the time the actual move has been beating the implied move. So the realized volatility has been higher than the implied volatility. You start to see how this is a good factor for us to at least start analyzing the name. Then we also see how the implied move, so what's priced in the option prices, compares to, let's say, the high level metrics of the average standard deviation. We obviously, if we're buying options, we don't want the implied to be very inflated and make it basically impossible or very tough for us to profit. We see that for Walmart, again, this is checked. So the implied 5.5, around 5.5 or so, is not so far from the average 5.3 that we're seeing. And then another factor, this amplitude of beat versus miss. We'll discuss this, break it down more in a second. This is basically answering the question, okay, when Walmart beats its, when the actual move beats its implied move, by how much does it so on average? And when it misses, by how much does it miss on average? You see, again, this is one of the data factors of saying, I basically, for long volatility, I want names where, you know, when they beat earnings, they beat them by a lot. When they miss, they don't miss by a lot in terms of amplitude of move. So you see, this lowers our risk reward, puts us in a better solution. You see that all these factors are checked for Walmart, and so it is showing up in this data pick. So this is one way of finding basically these strategies, these candidates for each strategy week after week. And so for today's session, let's actually look at Walmart and analyze it as how we would research it, how we would calibrate it through the different tools. Here, really, what caught our attention is basically these numbers. A high beat rate, favorable implied move, this amplitude of beat and miss. And now let's dive more into, okay, what's actually the profile there? How can we actually play this, and what's behind basically those numbers? Hope this makes sense so far. Okay. First step into this research is really to dive into the realized volatility. Because remember, guys, this earnings edge, really the foundation of it is, as we said, the market trying to price in a move and actually the reality of what usually happens. And so, you know, you can think that, oh, but markets are always efficient, right? Like the implied move should always be perfect. Well, as you can see, not always actually. And you can really think of many cases where, for example, and Walmart is one of them, you know, the volatility regime of some name on earnings can change with time, and the implied move, the priced in move, doesn't necessarily always follow. Let's look at Walmart. So what do we see here when we look at the past moves breakdown? Really just simple summary of what happened on past earnings. And we already can tell these blue shadows, basically, they tell us which earnings had in the past, basically saw the realized move, the day of release move, as you can see here in the central column, beat the implied move. So the more blue you see, basically the more beats of these actual versus implied. In other words, the more blue we see, the better it is for long volatility, if you like. And so what do we see for Walmart is we see that, okay, there's actually been a recent surge in volatility, at least even if we look at just from 2023, we're seeing this consistent, quite high moves of Walmart earnings, where frequently it beats its implied, but essentially, but also a very interesting insight here that we take away is that basically, if we look since 2023, the smallest move that happened on earnings for Walmart was around 5%. We have to go back to basically summer of 2023 to find, you know, occurrences of 2%, 3%, etc. So again, remember, guys, this is a statistical game where we're trying to really get closer and make assumptions on the distribution behind the moves for Walmart. And so an interesting aspect for us is we're seeing more and more blue as you know, for the last years, and especially consistent big moves, or at least we're not seeing 1%, 1%, 2%, Walmart is becoming more and more volatile. Okay, let's dive more into it. Let's put it more into numbers. Here we look at this famous distribution of moves. And so you see the average, you see the standard deviation. This is over the period of 10 years. And so in a very interesting aspect that really sort of summarizes this approach is look at the distribution of moves for Walmart. Now, obviously, as you would expect, most of the moves are around the average value. But then also the other good thing, and that points us to this long volatility, and so that the actually implied is maybe undervalued and there's room for higher moves. You see how it is quite Gaussian or bell curved, but there's actually a lot of tail basically on this distribution. So you see a lot of occurrences of moves outside of 5%, 6%, going up to plus 12, and same on the lower stand, going to minus 12. Now, obviously, also, this is not a huge mover, like your Netflix or other moves that sees 20%, 25% moves, etc. But everything basically is analyzed in context. And especially here, what's favorable is that the implied move that we're seeing, that around 5.5, 6%, is not that well priced in, especially based on not just the recent volatility, but also the fact that, as we said, the minimum move on the last years was around the 5%. This is a good example of how we, week after week, try to look for names where, again, we put ourselves in the best position possible, where we lower our exposure and we are exposed to a good profit. Here, lowering our exposure, meaning playing names where even the minimal reaction is somewhat outsized and will help basically offset our loss if, at the end of the day, our thesis is wrong. Okay, we'll continue. So looking quickly at these numbers, again, what are we doing here? We're trying to assess the profile of the name, the volatility of Walmart around its earnings, and basically come up with numbers of, as we said, so the minimum move around 5%. We saw that a high move is somewhere around 8%, and maybe a very, so bad case scenario, a small move is something around 2 or 3%, as we said, going back. Now, putting more things together at the end to compare, okay, overall, let's compare the actual to the implied. This is the macro comparison we're doing, as we said. This is what made the statistics that pointed to Walmart to begin with. We see these numbers that we like is that, okay, so 6 times out of 7 beating its implied, then these two amplitudes that we like, and we discussed how when it beats its implied, it beats it on average by more than what it misses it by. Again, this is, in other words, really means that even if it goes against us, basically our loss should be minimal, and our exposure to a good scenario is higher. Imagine if the right number was 5%, for example. It wouldn't be so appealing. It really means that, it misses by a lot, and sometimes even when it beats it by a little bit. Here, there's a 4-to-1 ratio, so again, very reassuring or pointing to that long volatility thesis. And then the last thing, so we have also a section about the move direction. This is, Ray, as we discussed, for also people who are just interested in the name for, not necessarily for the option strategy, etc. This is actually a tool. The screen is used by many types of traders for earnings in a lot of users, whether it's for these strategies or even, researching a name that you have in mind for your own portfolio or holding, etc. Okay, so this is the first part of the, studying the past, getting these insights of how does this volatility profile look for the name. Again, remember, we found the name from this angle of the data picks. There are other ways to find names. So we have a scanner for positions. We have an interactive calendar. Here, I'm really showing you the straightforward way. And so, okay, first step is done. Now, we understood the outlook of Walmart on its earnings. We can also filter for just the last 2 years and see how things behave there. Quickly see that the average jumped now when we look at just the last 2 years. We're even higher at 6.5. So a lot of things to do, but I think you see the gist of it of, okay, let's understand this volatility profile. And now this second step is let's actually go ahead and look at the actual option prices, how the market is pricing things. And now let's calibrate positions. Let's look at that risk reward that we discussed and try to customize things to, again, find the position that suits us, basically, in terms of its risk reward and its likelihood of success. All good on this part, guys. Ray, do you see any questions that we can help with before moving to the simulator? This perhaps the second layer of our of the workflow.
Yeah, I got some questions, maybe some
Yeah.
just comments and statements. I'm gonna save one of them for the end because it's about your time at Palantir, so we'll save that for the end. Um, okay, okay,
I
so
get that a lot. It interests a lot of people,
yeah, yeah, I
especially
imagine.
now.
I'll imagine, but we'll save that for the end. We'll get through the we'll get
Okay,
through
okay.
the presentation. All right, so first one here says he says he's kind of lost on the IV crush stuff, but he's curious on what kind of statistical work. Um, well, I guess this is kind of a little bit relating to Palantir, but what type of statistical work did you do for Palantir? What kind of skills did you gain? And with these skills, after looking at options, what kind of connection did he make between his math whiz and the option market? He says he hopes it makes sense.
I think I see the point behind the question. I think perhaps, as you said, maybe it's good to answer at the end. I think since this is a
Sure,
more general
sure.
idea, and just to put it there, I was basically what they call a deployment strategist. So I had the two hats, the technical and the business one. So I would develop models or basically work with clients for whatever the client is doing, basically. So really customizable depending on what the client is. But we'll dive more into that later on. Let's finish. So basically, this workflow now with the simulator. Now, what are we doing here? Remember, guys, basically, we found that some data is nudging us to look at Walmart as long volatility. We studied the volatility outlook of it. We got out with these numbers of, okay, interesting for us that the minimum move is 5%. So that number is, the threshold is quite favorable for us. A bad scenario is something around 2 or 3% move. A good scenario is something around 8%. And then all of the other numbers of why it's favorable and it's, a big beater, etc. Okay, now the question is, sure, that's all very great. How can I put this in practice with actual options? So that involves the question that, around IV Crush. What is the simulator? The simulator is actually a tool, an option pricing simulator that really models IV Crush for every option, so every strike, every expiration. What's the point is that you can now actually simulate positions, and as the name says, you can know what you're getting into in the most accurate way possible. So let's have a quick example here. The screen just opened up with a random call. So the 124, so at the money call, closest expiration, the stock price here was around 128 or so. Okay. What does this IV crush mean? It really means that, sure, as you can see here, the IV of this call is 89.9 currently. Now, after earnings, so meaning tomorrow, basically after open, this IV crush will happen. And so, as we discussed, so we did all the modeling to understand how each expiration and strike will behave and how the IV will drop. This is also very found. You can find it a lot in literature. There are rules basically where you can look for the same strike for one or two expirations, further expirations, to find the IV crush value. So in concrete terms, what does it mean? It means that this call has now an IV of 89.9. Tomorrow, basically, after open, it will drop to 35.2. Okay, now this is nice, but what does it mean for the option price? It really means this very important number that's good to introduce here before we go further. This is the break even. This is actually the concept of implied move. Now, as you can see, we see that the break even is 1.8%. Meaning that even for this at the money call or even deep at the money call, it still needs 1.8% move by tomorrow to be profitable. Now, this number is usually, as we said, is higher than how would this call break even be, next Tuesday or next in 2 weeks outside of Walmart's earnings. This is because of this IV inflation. So this tool really helps us, whether you're playing long volatility, short volatility, any type of position, to actually compose it and see how it will really behave through earnings. Okay, now we're interested in long volatility, as we said, for Walmart. So here directly I can open this classic strategies button and I can compose the closest straddle sort of in a pre-configured way. Okay, what is the closest straddle? 128 call, 128 put, as we said. You see its price here. And then the same, it's IV currently and the IV crush. And notice, guys, that the numbers of IV in themselves are nice to know, but they don't really tell me much. What tells me is their translation into this break-even number that we see here. Okay, this is the break-even of the closest expiration straddle, aka this is also what's known as the implied move. This is the number we were looking at earlier on. And so we see, just from starters, that this straddle position. Why do we go with straddle, guys? Because obviously, you see this pricing in of the move is not directional. Calls and puts see the inflation of IV. And so the market is not pricing in a direction of move, it's really pricing in an amplitude of move. And so these volatility strategies play, again, the whole edge is around the amplitude of the move. This is what we were seeing in the distribution, etc. Okay, so this is the default position, plus minus 6% is a break even. And remember that we said that this is what most people would have in mind for earnings, that sure, if it goes against us, look at the P&L here when the move is really worst case scenario, 0% move. So the stock not moving. Keep in mind, this is very unlikely given what we've seen in the moves analyzer. But still, you see quite a big loss, 69%, 70% loss, really in the worst case scenario. Again, we looked at the past move, the realized move. We saw this insight. We sort of saw that a realistic high move, or what seems to be a high move, is around 8%, especially in the recent years. And so that will make us a reward of 37%. Okay. This is just to give you an idea of the classic way to play earnings, but that comes with sort of a mild risk reward. See, the exposure is quite good. Now, how do we optimize this, and why are we playing these positions for Walmart? It's because, remember, we saw that there is some accentuated volatility, and then perhaps the implied move that we're looking at, the 6%, is actually quite favorable, because remember, the lowest move, the minimum move that happened, is around 5%. So here's another way to even improve our chances and even basically put ourselves in even more favorable positions, is that I'm sure a lot of people are familiar with the approach that one of these positions of the structures used for long volatility is what we call inverse butterflies. So what are these? It's basically the same long straddle, but now on top of it, selling a wider triangle. So here you see, still with the closest expiration, 124 put, 132 call. What does this have the advantage of doing? It lowers our entry cost because we're selling options, obviously. So this is another aspect of it. But especially what we like is this new break even that you see here, where we reduced the default expectation, the amplitude price in was 6%, as you saw. By making this an inverse butterfly, so adding the short strangle, we were able to push the break even lower to now plus minus 4.2. And so this is exactly what we mean by how we can play this earnings edge of this mispriced, basically, volatility around earnings. Because remember, now this 4.2% is really favorable compared to the outlook of past moves, how that minimum move is around 5%. The lowest that seems to happen is 2 or 3% and goes up to 8%. Guys, the whole point is that this is again statistics, so it doesn't mean that necessarily Walmart will move 5% or 6% or move higher than an implied move. It just means that statistically we have a higher chance. Again, think of it as every earnings move is picking from the distribution. It's really that like that example of you're having a bag with balls of different colors, and so if you have 90% black balls versus red ones, well, 9 times out of 10 when you pick a ball out of that bag, it will be red or black. It's really the same idea behind it, that we're pulling from a statistic. And so the statistic, the distribution here is very favorable for us, and we can improve it when we're playing it by pushing this break even lower. And then we see our risk reward, that this is what we meant by, we can play earnings with a even more conservative approach. You don't have to go with that, as we saw, 60%, 70% loss of the closest straddle. Positions like this, as you can see, come with a more favorable outlook, but also you see the reward at an 8% move that seems to be the high, as we said, of the last years, just a 16% reward, which is obviously, honestly, not so bad. And the idea is that, again, this is the repeatable aspect of it. So we don't really care that it's Walmart this week. The idea is that really week after week, we look for names that have this type of outlook. And so, in the last weeks, we had Palantir, WFC, Schlumberger, just from top of my hand, names that had the similar outlook, where high recent volatility, a somewhat high minimum move, and then an implied move that's not fully priced in. pushing that implied move even lower with inverse butterflies, basically you see it puts us in even more favorable positions. And so in terms of risk reward, you see here that even for the small move of 2 or 3%, we would be losing 14%. Compare that to the other big number of the straddle versus, okay, if the good scenario happens to it's a big move, we could be looking at 16%. So see, low risk, low reward, but with high likelihood. Why? Because again, this break even is quite favorable. So just to take a step back, what did we do here basically? We just found a name to play for tomorrow, again, on these macro level statistics, where we're seeing that there's perhaps a mispricing in the volatility of the stock around earnings. We pushed the analysis further to really calibrate a position that would improve our likelihood of success because of this very low break even. Other people, obviously, you can also go with the classic straddle or maybe a wider inverse butterfly, as you can see here, so you can compose on your own or just browse through the list. Your risk reward will change depending on the position. And so you can, for example, go with the plus minus 5% that will have more reward, more risk, but a slightly higher break even. So just to take a step back, this is one example of, and so by the way, you can also paper trade positions on our platform. So for really people who are starting and want to practice, these strategies with different positions. So you can basically paper trade this with this type of position, this inverse butterfly. You can try just a closer straddle that we looked at, a wider strangle that would come risky. This is really part of the fun of earnings, where you can really find a position for whatever you desire, and then week after week, as we said, this agnostic research of finding out names like Walmart for long volatility, like other names for short ones, depending on the profile, IV Rush that we discussed, the momentum, preparing your plays. And I'll just wrap it up by saying one of the advantages and a thing that really our members love around earnings that I keep hearing is basically the process and the workflow of preparation, where usually there are people who would do this research of preparing the names for the or the plays of the upcoming week on the weekend. On Monday they would find a couple of hours here and there whenever they can. The whole process is basically before earnings. So what we did now for Walmart, basically you could have done it this weekend, okay? And so do it for Walmart, do it for other names, for other strategies, using the other tools, etc. And then it really becomes a matter of just later on during the week when we need to play Walmart. So here we're seeing it releasing. So after close today, it really comes down to coming back during the week just to basically recalibrate, for example, the inverse butterfly we were looking at. Why? Because if we did this research on Monday, the stock moved perhaps since then until the time of entry. And so the time of entry, as you can see, is usually the afternoon or before close, the day before earnings. Because why? We want to be positioned for the move that will happen the next day, right? So we want to have the strikes around the stock price then. When it's really just a matter of coming back on Wednesday here, and so rechecking your inverse butterfly, your straddle, whatever it is, unless something very big happened, of course, you would find that usually those numbers are quite close to what you would find in the end. And so part of what you can do on the platform is also add names for to do this preparation, and basically find them in your home screen to get a reminder that, okay, tomorrow you have this name coming up for the strategy, the next day you have this name, the entry is before close, the exit is afterwards. And really, again, agnostically, week after week, repeat this process basically with the best names for each strategy. So this is what you can find in your home screen in the coming up section, and also so all the positions that you can follow and so close from here. And as we said, practice and refine. Okay, I think this was a good tour. I don't want to overwhelm people with too many details. I think it was good to see concrete examples, some numbers, how we calibrate things, how we look at things. Hope this was clear. Happy to take any questions about this array or anything that people have in mind. And hope this was clear enough for everyone. Let me pull up Walmart just to have it in case.
Oh, man, that was great, man. That was great. We do have a couple of questions
All right.
here. First one I'll ask is from Lisa. Lisa, what's up? How's it going? She's sorry, I missed the time. That's all right, Lisa. All right, so she's asking what specific metrics do you check before entering an earnings trade? IV rank, expected move, historical move, liquidity. She joined late.
No,
And then I guess the second question to that, do you prefer pre-earnings IV expansion trades or post-earnings IV crush setups? Do you trade large caps differently than small caps?
great question. So I'll start with the first one about the factors basically looked at. So you're right. I think perhaps she joined later on, so she can rewatch to get the full picture. Let
Hmm.
me just, in a nutshell, summarize. Basically, it's not far from what you said. There are basically some factors. Now, obviously, I didn't speak about liquidity and spread. We try to always focus on names, stocks with liquid enough options, and avoid, names with high spreads or few volume. So that's like the fundamental or the given for us. Then the factors to check. So, for example, here, as we said, for long volatility, for buying options, and actually, while we're at it, let me actually pull up a stock that would be the opposite, good for selling. Actually, name was it? I think it was low. I think the week after that. So what do we look at? It's really what you said. So obviously we see how some of the factors we saw in the data picks. I'm showing them here in the moves analyzer. We want the implied move to be not very far, at least, or close to the average move. In other words, it means really that implied volatility and historic volatility are not so far. First thing, and then if we're selling options like we're doing for low here, we obviously also want to make sure that the realized volatility, or here the past moves basically of what happens on earnings, are quite contained. So it's not a very volatile distribution. So for example, like this one here, where really most of the moves are around the average move. So in other terms, that the realized volatility is somewhat contained. It doesn't have a huge standard variation. And then other numbers like the ones we were looking at for Walmart. Now compare them for low here that we're seeing. Remember, we saw that Walmart was good for long volatility because when it beats by a lot, or at least when it beats by more than what it misses by. See how low is not the same. Low, first of all, the beat rate is very low, but also that amplitude of when it beats versus when it misses are basically very close. So see, this is what we mean by each name would have a different outlook of the how to be played. And so to answer your question, these are some of the factors we look at on top of liquidity, spreads, etc. But really to snipe and decide which strategy is best for each name. And then the second question, remind me, Ray. Sorry, I think I forgot what was about.
Let's see. I'm not sure if you answered this. Yes, and do you prefer pre-earnings IV
Oh yeah,
expansion
before, yep,
trades
sorry,
or
sorry.
post-earnings?
Yep. So this is a good question. Now, as the founder and CEO, I really would deflect the question to what our members like. I would actually try to answer like that. What we see is that usually people who are familiar already with earnings, people who are familiar at least with the notion of IV crush, okay, what happens through the release, they would perhaps be more excited in the preparation of the long and short volatility. And as you can see, basically the reward and loss numbers can be more exciting for long and short volatility. So as we saw the example for Walmart, etc. The IV rush trade, as we said, is actually also great, and it comes with the advantage that they are more conservative, right? So especially if we play the last afternoon before earnings. So let's here open up the tool of IV rush. We won't have time to explain in detail how everything works, but let's just open up a name just for the illustration of it. Usually we would focus on, say, the last day of before earnings to play that IV inflation. And so here what we're doing, as we said, we're battling the IV inflation versus theta decay. The reward perspective are around 5%, 7%, 8%, not that high, but also the loss numbers are also quite low because we're only exposed to theta decay at for the last afternoon. So you see for Walmart here, without getting into details, but the impact of theta decay is just lowering basically from 712 to 687. So you see, since IV rush comes with a more conservative profile, perhaps I noticed it's a good entry point for people who are beginner really and starting in the earning strategies as a whole. So they're familiar with options, they know what options are and price volatility, etc. But did not really hear about these volatility strategies. And so a good foot in the door is actually to start with these inflation of IV. Okay, and so really have these very simple entry and exits of we enter before the release and then exit a couple hours later, 3 hours later or so. And so also comes with a more conservative risk reward. While as we said, people are more familiar with really like these bigger returns on long and short volatility. But I think that especially short volatility, I recommend that you at least be comfortable with the concept of selling options in general. I know that a lot of new people or beginners in options in general perhaps misjudge the how to look at short volatility. This is what I always keep saying, that when we calibrate short volatility, so selling options, really our mindset should be about the max loss. What should we cover and really protect ourselves? Different mindset from the long vol, where we can be since there is no naked positions, etc. So there's really this point about the mindset of things. And so if you're a beginner, IVRS is great because you see things right away. Basically, things start happening if you enter the last afternoon in an hour, 2 hours, and this is part of a lot of fun in our Discord, where people are following names, monitoring when is the expected rise, etc. Long and short volatility plays are more how do you say, with more meat, if you like, because with this more customizable risk reward and these bigger numbers, etc. Hope that makes sense, Ray. And thank you, Lisa, for the question, by the way.
Yes, makes perfect sense. All right, next question here. Attila says that he's familiar with general option strategies, but earning trading is new to him. The platform looks quite complex. Do you offer trading or guidance on earning strategies and using your platform?
Good question. And so actually, I'd like to reassure that the platform, so the data might seem complex, but actually we went into great lengths to, again, this is the whole point of the what we're doing, to try to make it as intuitive and easy to take on as possible. And so whether you're familiar with these strategies, and so you don't need any guidance, etc., you would find value in the tools directly and how to use things. But then we also, as we said, really went into great lengths. So for example, for people who are beginners, even just in options in general, so we have this whole option courses basically section, where this is really basically recorded sessions of me and other traders that were explaining things and really starting from scratch on options. And so these are little videos that you can watch really to build that fundamental knowledge of just options. Here we're talking really intrinsic value, etc. Take your time on them. We have some quizzes, etc. So very much you can really much spend time. A lot of people go through these, as you can see, 20-30 minutes each, really to build the foundation. Now once you've done that, and also by the way, in our Discord we have a full section on for beginners and live calls for them, etc. Once you have that layer of understanding the basics of option, getting into earning strategies. So this tutorial screen actually might sound complex, but as you can see, has really been thought to help you take on and understand really each step of how to do things. So for each strategy, you'll find these different sections of how to play, what to look at, and especially really a breakdown of how to research things on the platform, which tools to use, which things to look at. And I'll finish on by saying that the other good thing is that, sure, and I recommend that, trading or anything in life, only jump in when you really feel comfortable and familiar enough, etc. We actually baked in a lot of things. So, for example, when you looked at the moves analyzer or the simulator, you see that we try to make things as intuitive as possible, and explaining the numbers of these break evens and comparing them to the distribution of moves, etc. But a lot of functionalities that are baked in, for example, this paper trading, really helps you to get a hang of this position. And so you can practice once you've learned the basics from the tutorials, from the courses, also from our Discord and our live sessions, etc. But then you start applying, and actually the functionality strategies with the tool will help you. So, for example, the paper trading, where you can paper trade. So, IV rush, long and short volatility, momentum. You can practice different positions. So, for IV rush, for example, you can practice how a straddle versus a triangle behave. Showing you here just 2 example positions. And so compare how would you handle the entry and the exit. How would you handle the calibration? You have virtual cash on the platform that you can assign to your portfolio. So in a nutshell, sure, these earning strategies and the data behind it is quite, can be heavy, etc. But this is the advantage of what we do is adding a layer of between complex data and having an interface that's as simple as possible, and basically have algorithms and models, etc., do the heavy work to really tell you. Just as when we looked at the data picks, we saw that this name is good for this or this strategy. Is really surfacing and guiding you to, as you saw in this live session. The workflow is quite easy to take on. One tool to the other tool, get this number, look at this number, look at this aspect. So I'm sure that they can seem overwhelming, but a lot of our beginner and new members really get a hang of progressing also with these strategies. So starting with IV rush, moving to long volatility, then trying short volatility, momentum, etc. So no worries, I'm sure you'll have plenty of fun picking all this up.
All right, great. All right. I think I see someone typing. If you guys got any last questions, get them in. I'm in.
Or maybe I can answer the Palantir one. It was about
yes. I was gonna circle back to that one.
It was about the math modeling, basically, in here versus what I would do for companies. So just for context, so people understand, the concept of deployment strategies, and you can imagine it's quite fun for me now seeing all the frenzy on Twitter about, especially Michael Burry seems to have woken up to really his case on Palantir. So I see that perhaps not a lot of people will understand how things work. So the deployment strategist is basically a person that's deployed. So it can be me by myself or with other team members. So usually you would have 2 types of roles. People like me, so deployment strategists who are so have technical skills. And so for myself, I was full-on data scientist basically before joining Palantir. I was working at another startup, really making hard-on algorithms, etc., for a specific technical use case. But then since in Palantir, I moved to this role where same technical basically abilities, but now also interface with the client. So my job is also to embed with the client and put my technical skills into application for something that's useful for him. Okay. Now the difference that might confuse people is that, and I've seen this on a lot of Twitter feeds of, so how does that work? Shapes. It's very different from. I see people, for example, confuse it with what Accenture or Deloitte as consulting firms would do. So an Accenture person, a Deloitte person, would basically embed with the client team and really work for them. Right, so he would basically have tasks to, run analysis, clean data, build dashboards, for a specific use case for the client. What Palantir does is not at all in that approach. The idea is we basically embed with a team, but to basically help them do whatever they're doing in the Palantir platform. So I was obviously on the commercial side, so using a lot of the Foundry platform. So we don't actually go with the team to help them work on whatever they are working on. We try to idea that we would have a use case to basically redo or even aim at something that basically a project that they were hoping to do in a longer time span, but we would propose basically a way to do it much faster and in a much much more efficient way. And what's really the signature there, what really breaks the silos and makes things advance, is this thing of putting data together in one place in the Palantir platform, this Foundry platform. And so you end up basically being able to execute and work on these long-term projects that don't exist yet. And this is the powerful thing about Palantir, is that so the deployment strategies combined with the power of the tools of the Palantir Foundry is able to execute very quickly, basically. And so things that would take on, 6 months, a year or more, we'll basically be able to do them in few weeks because of the advantage that, we put everything together in one place. We understood what people are doing, and we basically come up with ways to help them do it better. Okay, so I'll just give a random example without citing names, but let's say it's you're working with a supply chain people department that optimizes or is trying to solve a specific question about, I don't know, let's say redundancy in the different material it uses, for example, and where they're sourced from, etc. Now, they would have their own workflows of doing things. Okay, a lot of Excel sheets here and there, some teams working on this, some teams working on that. We will basically come in and have a higher view to try to understand, to unlock what you're doing and to actually be able to go further. Let's put all of this data in one place. And why do we do that? It's really the fact that a lot of these workflows, people would struggle to have data speak to each other, and that would that would be very essential to what they're doing. But it would take much longer to contact the person, put them in the loop with that other person for that specific use case, while having everything in one place. Now we're able to do, so what you're doing, basically what you have been doing, or the workflow you used to have, now can actually be optimized. Let's actually build you the suite of dashboards or this type of analytics that you can run, and so that will fast forward and really improve what you're doing. And so we will embed again really on these long term. So to go back to the question, really my skills were really interchangeable. So as long as I understand data and analytics, basically, and statistical modeling, and so I worked on multiple things from very technical to not so technical. But at the end of the day, basically you do a modeling that this is where it links back to EarningsWatcher. That's the most useful for the client. So here my mindset with EarningsWatcher is that basically my clients are retail traders. Okay, some of them know these option strategies, others don't. Okay, and so we're basically okay, maybe going too far into the metaphor, but think of the EarningsWatcher as the foundry platform now, where you used to have the past volatility numbers in some Excel sheet, or you have to compute them from one other source. Then you have the IV crush numbers of how IV impacts every option in strike and expiration. In some other number, in some other source, you have the risk reward and what positions are playable. In another source, the drift and whatever we discussed of momentum, etc. In another source, you're trying to play earnings, right? And so you pick a little bit of this data, a little bit of that data. You don't have a guided and really a disciplined workflow. Really, not so far from basically what clients would be doing before Palantir, right? When they try to solve something, there's not necessarily a workflow to do it, because there's no really 360-degree place, as we said. Now, with earnings, same way as with the clients, having everything in one place directly opens up more room, because you can say, oh, sure, just from the fact that, top of my head, I'm combining, IV crush data with momentum data. And so funny, maybe I see that actually names that see the highest IV crush also see the highest momentum afterwards. Things like that. I don't know, maybe some other insights can come up from putting all this in one place. And so now I'm trying to answer basically or deliver to retail traders that same discipline and approach of how to do things, just as a client team would do with the modeling. On our platform with all the different data, and how to make it accessible is that layer of intelligence, that layer of really intuitive things that speak to you, that help you go from point A to point B. This is what we have been seeing. So the all the numbers in the moves analyzer, the average move standard deviation, implied statistic, blah blah. Data can be extensive, but it's really how you interpret it on top of it. And so just to finish up, this opens up much opportunities where even the clients we would leave after, so we would finish the use case we were working on for Palantir, and even after we leave, they're basically able to now even open up more use cases and even answer more critical operational questions in a much efficient way and with much speed, just because of the infrastructure, if you like, the infrastructure of data that we put in place. Now, when I was there, really the machine learning work was just beginning. So there was something called Foundry machine learning back in the day. It's really the ability to run machine learning and AI on top of whatever you have, right? You can see how that's powerful once you have everything in one place. Really, just again, same as you would do with earnings, where now you have everything in place. Every week, you can see directly, oh, Walmart is really interesting to look at this week because of this and that. Okay, next week it's Low or Home Depot or whatever name because of this and that. Same thing that Palantir client would be very happy to have, where in his workflow, I think of some pharmaceutical company, for example, that used to have this very tiring process to find prospects and things like that. We really made it very fast track and enable even more action. Hope this makes sense. The general description of it, how to relate basically between my two experiences and how they relate together. Let me know if you need more, etc. I'm happy to help.
I mean, no, that was great. Appreciate your time. I think that's gonna wrap it up for the questions. JJ
Great.
he had to hop off. He wanted to pass on the thanks for coming on. He learned a lot, and he also left a message in French, which I'm not going to attempt to read. He told me to read it, but I'm not going to attempt. Um, but I know he said merci beaucoup. I know that. But
All right.
yeah. Oh man, thanks so much, man. That was awesome. Yeah, you got a great software here. I'm sure a lot of
Thank
people
you
can
for
relate.
having me. Glad to be here. Hope this was useful for everyone and enjoyed the questions and the presentation. So yeah, thank you guys.
I mean, one more thing before you go. Just
Yeah.
let the listeners know where they can find you if they have any questions, that sort of thing.
So the website is earningswatcher.com. We're also on Twitter, handle earnings_watch. You just type earningswatcher, you'll find us with our calendars, etc. We have also a free section on Discord. On the website, there's this dialogue box that also directly reach anyone available from the team, so you can get me there. Feel free, welcome on board. We're happy to have you, and you'll always find someone to help you answer your questions, guide you, etc. So you're very welcome.
Awesome. I'm in. You're the man. Appreciate you. We'll be in touch.
Thank you, guys. Talk
All
soon.
right.
Have a great
All right.
rest of the day.
All right. Bye.
Cheers.